Hi, my name is Ben Reppond. Welcome to my YouTube broadcast. Today is March 5th, 2025. Let's get into the dashboard. And as of last Friday, the February 28th, you can see for the week of that preceded February 28th is in the yellow box. So that is, you can see the various indexes, the U.S. indexes and the foreign indexes. What's real interesting, I haven't seen this before, EFA, developed markets, number one, higher than all the U.S. markets. Bonds, number two by quite a bit. And then we go to emerging markets, which is down quite a bit for the week, but for the year to date is number three. And then the four U.S. markets, Dow, S&P, NASDAQ, and Russell. So pretty interesting mixture. And then to the right, and then you can see in the pink box where they are year to date. The most negative being the Russell 2000, and the most positive being developed markets and bonds, long-term government bonds. On the far right, you can see if these are above or below their 20, 50, 100, and 200-day moving averages. And if they're below, it's red. If they're above, it's green. So again, a mixture. When you look at the, this develops more of a pattern here. You look at the sectors within the S&P 500, and you can see, and again, this is ordered from the pink box year to date, which is basically January and February. Healthcare, financials, energy, telecommunication, real estate, consumer staples, basic materials. When you look at all of those tend to be mostly defensive sectors. And then you get down to the bottom, the most, I guess the ones with the most alpha, the growth-oriented ones, the technology and consumer discretionary, and retail, all negative year-to-date by quite a bit, and negative for the week. And so you can see the green dots and red dots. So it's a pretty clear pattern that the ones that are at the top, primarily defensive. Those at the bottom, primarily growth-oriented. Okay, and this sort of tells the same story at the very end. You can see the market is going up over this 30-month period of time. This is the S&P 500. But at the very far right, at the upper right, it comes down and touches the 20-period moving average. Is it going to break through that? Now remember, this is not daily, this is weekly. So for the week, this week, the first week of March, is it going to break through there and go on down further, meaning from Friday, end of close on Friday to the close on the next Friday? We don't know that yet. So, but if it does, usually that spells more risk. But we'll have to wait and see. There are times where you can see it does go below there and then it bounces right back. But when you go in for longer drawdowns, deeper risk, when those happen, they start with a break below a moving average. So to be determined. And then this does the same thing. It just puts it on a candlestick chart versus a line chart. So you can see those last two candlesticks on the very far right going down and touching the moving average. Now, this is a relative strength chart comparing the NASDAQ 100 to the S&P 500. Numerator NASDAQ, denominator S&P, 30-month chart. Here, and so if it goes up, it favors NASDAQ. If it goes down, it favors the broad market, the S&P 500. Here you can see, and I drew the line to show you the general direction, but when you look for the last year or two, it's mostly been up and down going across the chart. So, and it has broken below the moving average. So that's signaling that the NASDAQ is going out of favor more and that the S&P 500 relative to the NASDAQ is stronger. This does the same thing. It does it with the growth stocks in the S&P versus the value stocks. When it goes up, it favors growth. Goes down, it favors value. You can see for the last couple of weeks how far down, how sharply it fell at the very end, favoring value. And it has dropped below its 20-period moving average. So signaling, generally speaking, I would say this is signaling is more of a bearish signal. The S&P 500, the large companies, 500 the largest, compared to the Russell 2000, the 2,000 smallest companies on a relative strength basis, it's showing to the far right, look how that's going up. So it's telling you that small companies, small cap, are weaker than large companies to that extent, and vice versa. Larger companies are stronger than small companies. So, and it's quite a bit above. It's quite a bit above the moving average. Where does it go from here? I don't know. Again, I would say that's a bearish signal because when companies tend to get hit in the market, the small cap tends to get hit first. Long-term government bonds, those came up. You saw that. That was a positive thing, bullish sign for bonds, which means interest rates are moving down and the price of bonds, therefore, is inverse to that and moving up. So you see that it broke through the moving average and is on its way up. How far will it go? I don't know, but that's a bullish signal for the price of bonds. Probably corporate and government. These are just long-term government, but it could mean both. Okay, the dollar had, for the last month or so, had a pullback. You see that at the upper right, and then last week tipped back up again. So the dollar is now moving up. This is a 4-year chart. Gold has been doing well. It's been going up, but last week had a pullback. You see that at the upper far right. Same thing with silver. Silver's weaker, but it's been going up, but it had, again, a pullback, a little more than gold did. Bitcoin has been pulling back. It's been showing weakness, and you see it's also dropped below the 20-period moving average. Volatility index, no surprise here with the negative tone for last week, that volatility went up and is now up around 18. Going back, 6, 8, 9 months ago, it was down around 12. So it has definitely moved up. My trigger is more around 24. When it moves up above 24, that's where the higher risk is, but we're not there yet. Asbury 6, last week had 1 positive indicator out of the 6, 5 negative. This week, all 6 are negative. Asbury, cross-asset relative performance, so comparing one asset to another. Bonds, and I'm looking at those that are in the last week, the last month, the last quarter. Bonds stronger than stocks, equities. Low volatility, stronger than high beta, high volatility. Large cap, stronger than small cap. Again, we saw that in the previous chart. Blue chips, the Dow, stronger than, which tend to be more defensive, stronger than the broad market, the S&P 500. The broad market, S&P, stronger than the NASDAQ 100. Value stronger than growth. In the bond area, government bonds stronger than corporate bonds. Corporate bonds, high quality corporate bonds, stronger than high yield junk bonds. And long-term bonds stronger than short-term bonds. So the U.S. did well relative to the rest of the world, generally speaking, last week. So the U.S., if you look at this for the last week, month, and quarter, the U.S. is stronger than Brazil, Malaysia, Taiwan, India, China, Thailand, Saudi Arabia, New Zealand, and Australia. The ones that are stronger than the U.S. in those same 3 time periods: Spain, the UK, and Hong Kong. I'm showing my chart here, my U.S. versus South Korea chart, and you can see that the U.S. did stronger against South Korea this past week because of that little tick up at the upper far right. And it's still, the general trend is up, favoring the U.S. over South Korea. Spot prices on gold and silver. As of last Friday, February 28th, gold was $28.59, down 2.7%. We saw that on the gold chart. It was a tick down. Silver, a bigger tick down on the chart, and it lost 4.1% from the previous Friday. The gold-silver ratio moved up from 89-1 to 91-1. The higher this goes, the more it is considered that silver is a better value. If you're concerned about the gold-silver ratio. Okay, a monster box is a box of 500 rounds of pure silver, or almost pure silver, and the bullion, generic, and the cost of that is $16,270 as of last Friday. That includes $1.04 markup per ounce. This number is coming down. It tells you, even though the demand is higher, the prices, spot prices are higher, and it looks like the demand is higher, the demand is actually lower, because demand tends to trigger off of the spot price rather than, off the markup rather than the spot price. When you put the two together, the cost is $32.54. Now, that is from my son Preston, who is in that business, and that's what he would sell it for. Each one is different, so you could check with your local retailer and see what they would sell it for. I'm not a fan of buying it over the internet. I tend to like brick and mortar retailers, particularly for this, but that gives you a benchmark for what it's going for. Okay, well, thank you for watching. If you have questions or comments, leave them in the comments section below, and don't forget to subscribe. Thank you.